All right, it's October 22nd, 2025. The big picture today is a major conflict. The headlines are pointing towards calm, but the big money? They're betting on chaos.
So what you see on the surface is this de-risking narrative. But when you look at the options flow, it's telling a totally different story. We're going to break down these signals and see where the real opportunity is.
Okay, so there are two big geopolitical drivers really moving things right now. Let's dive in. On one hand, you've got China risk, which looks like it's fading. There was a big military purge of 9 generals, which makes a Taiwan invasion, well, pretty unlikely for the next year or two. And that's a huge de-risking event for semiconductors. But on the other hand, energy risk is definitely rising. Ukrainian attacks are seriously hitting Russia's infrastructure, and that's putting real pressure on global energy supply. And get this, we're talking about a reported 40% drop in Russian oil refining capacity. Now, that's not some forecast. That's a direct economic hit right now. It tightens up the whole global energy market and makes that risk very, very real. So you'd think, right? One big risk is fading, another one's rising, maybe it all just cancels out. But that's not what the options market is signaling. Not at all. Let's try to decode this volatility puzzle. So let's look at the VIX. Just to recap its recent journey, we were sitting at a low of 15, then we had that October fear cycle that spiked it all the way to 25, and now we've settled back down to 19. This pullback right here is exactly what's creating this sense of calm you see on the surface. But this is the data point that completely contradicts that calm. While the spot VIX has dropped, there's been, and I'm quoting here, huge option paper buying up November and December VIX calls. This is the institutional money. They are positioning for a big volatility event before the year is over. They are absolutely not buying this all-clear signal. So this brings everything down to the micro level. How does a macro tension like this actually resolve itself? Well, it takes a catalyst, and right now we are heading straight into the earnings gauntlet. Now, that China news has a direct and, more importantly, an actionable implication. With the Taiwan risk dialed back, that provides a real tailwind for the semiconductor sector. So now you can look at ETFs like SMH and SOXX and actually evaluate them on their fundamentals again, not just on geopolitical fear. All right, let's talk about a key test case for the whole market. Google. They report earnings on October 29th, and this is going to be a major tell. Is this the breakout moment for big tech, or is this the start of a breakdown? The setup for Google is pretty clear-cut. The bull case is all about that strong Gemini AI traffic growth. We're talking around 300% year over year, plus improving margins and that fortress of a balance sheet. The bear case? Well, you've got a high valuation, a new direct threat from OpenAI's Atlas browser, and some very real concerns about rising CapEx. So when that report drops, this is the only scorecard that matters. Watch these numbers. You're going to want to see search growth beat last quarter's 12%. Cloud growth needs to come in above the 29% projection. And this is the big one. CapEx guidance has to stay below that feared $90 billion level. These 3 numbers will tell you exactly where the stock is headed. Okay, a quick but important disclaimer. This content is purely for educational purposes. It's an aggregated analysis from public sources, all to help you stay informed and sharpen your own decision-making. You must do your own research. This is not financial advice. All right, let's take all this information and translate it into some actionable market scenarios. So I see 3 potential paths from here. The base case, we're probably looking at a choppy range-bound market as these 2 big forces, geopolitical calm and volatility bets, just battle it out. The bull case, the de-risking story wins out, semiconductors lead the market higher, and earnings surprise to the upside. And the bear case? Well, the bear case is simple. The VIX options traders were right all along, and a catalyst, probably disappointing earnings, triggers the next big wave of selling. So first, let's really break down the bull thesis. Look, the bull thesis is straightforward. You take that Taiwan tail risk off the table, and it allows capital to shift its focus from fear back to fundamentals. That means money rotates into risk assets, and the most logical destination for that money is the semiconductor sector, which is finally free from that geopolitical overhang. Okay, now for the other side of the coin, the bear thesis. The bear case says you need to trust the options flow, not the spot price of the VIX. This pullback we're seeing, it's just consolidation before the next leg higher. That institutional positioning for November and December, that's not a guess. That is a calculated bet that a major catalyst is on the horizon, and it's going to trigger a significant market move. So, with these two completely conflicting outlooks, how do you position? Let's look at a couple of potential risk-managed setups you could use to express these different views.
All right, first up, a bullish strategy on semiconductors. We'll use the SMH ETF to play that geopolitical de-risking theme. Second, a neutral, or more accurately, a pro-volatility strategy on Google, which is designed to profit from a big post-earnings move, no matter which way it goes.
So for SMH, a bull call spread is a smart way to play this de-risking theme. The structure gives you defined risk upside, and it's really capital efficient. What kills this trade? Well, any significant new escalation in US-China rhetoric, or just a simple technical breakdown below a key support level, and the thesis is invalidated. Now, for Google earnings, a long strangle is a pure volatility play. You're buying an out-of-the-money call and an out-of-the-money put. You're positioning for a price move that's bigger than the total premium you paid. You don't care about the direction. Now, the huge risk here is Ivy Crush. If that stock doesn't move enough after earnings, the implied volatility is going to collapse, and that position will lose value fast. Make no mistake, this is a high-risk strategy. And one last time, the final disclaimer. This is not trading advice. It is a market update to keep you informed. All markets carry risk. You need to trade your own plan, manage your downside, and always verify all data for yourself.